that we're going to advance, because mortgage is going to be like the biggest debt you're going to owe in this country. It's going to be like the biggest debt you're going to owe. So we want to know that you are capable, that you have the capital to be able to. Hello people, welcome back to another video. This is one of the series on mortgages. The first one I did was on down payments if you want to do a mortgage, especially for first-time home buyers, which kind of concerns immigrants, because most of us are first-time home buyers. So this is the second series in the video, and I'm going to be talking about pre-approvals. So mortgage pre-approvals is like going to your financial institution to get to know what amount of mortgage you can afford based on your income, based on your credit. It's a kind of, we call it pre-approval. Like it's an approval with a lot of conditions. Initially, you're going to go with you're going to present your income documentation for them to be able to run like a kind of pre-application for a mortgage, and then they're going to tell you how much you qualify for based on your income, as I said, and based on your credit. So I'm going to be talking about the in and out of mortgage pre-approvals. So first of all, mortgage pre-approval is a free service by the financial institution, and they're going to do a kind of credit check on you. So yes, they're going to do a credit hit on you. Mortgage pre-approval is actually optional. Some people go directly into their mortgage application, like they go with, okay, I found the house I want to buy. They go with the MLS listing, like the documentation for the new house they want to buy. They go to the financial institution and do an application for the bank to fund it, to do the mortgage. But other people have to first go in to see how much they qualify for, what type of house they should be looking at, how much kind of house should they be looking at, because you may be thinking, okay, I want to buy a house of like 700,000. You've been searching the market and you've been looking at houses around that range, but you don't know if your income will qualify for it, if your income, if your credit, other debts you already have, if all these things put together, if the financial institution can approve you for that kind of loan. So it is optional. Some people just go directly. When they do the application, the financial institution tells them, yes, we can do the mortgage for you, you've been approved or not. But if you really want to be sure of what you should channel your energy towards, then you should go for a pre-approval. So as I said, it is free, and they're going to do a credit check on you. Sometimes depending on the financial institution, you could do the pre-approval online, or you could visit the office to do the pre-approval. So they have some applications online that you could input your information. They'll ask you for your income. They'll ask you about other credits you have, like loans, like lines of credit, like if you have other things, other loans like credit card, how many credit cards do you have, just to know how much you have in debt. Because as an individual, there's a credit limit everybody is assigned to, so they want to know what you have out there before doing this mortgage application. It's also going to check your credit to know how good you are with your finances, like your credit cards. Do you max it out? Do you do your payment regularly? What is your credit rating and all that? All those things are what they ask for you on the online portal. Also, if you visit the office, so it can be done immediately. If you go to the financial institution, you could get your pre-approval done immediately, and then you get to know how much you qualify for. So they could tell you that, oh, based on your credit, based on everything, this is the amount we are approving you for. Meaning that based on your down payments and all those default insurance I talked about in the other video, this is the amount of house you should be looking at. So they could tell you, we're approving you for 400,000. So you can't go into the market and go and be looking for a house of 600,000. You would know that, okay, I can only afford a house of 400,000 based on this mortgage pre-approval. So the pre-approval lasts for within 1 to 4 months, meaning that whatever they approve you for, you could use that value. You could use that value to look for a house. Like when you get a house that you want to buy, mostly the realtors will want to see a pre-approval to see that, okay, you can afford this house. So you could, when the financial institution does the mortgage pre-approval for you, they give you a documentation to show, they've run an application on you and this is the amount you can afford. So you could give that document to the realtor, and then they will know that yes, this person is a serious potential buyer. Like they already know that the bank already is ready to stand for this person and this is the amount. So if for example the house is 350 and then the financial institution is approving you for up to maybe 450, they know that okay, this person has more than enough. But if the bank is approving you for 350 and you're going to a house of 400,000 or 450, the realtor will look at you like you cannot afford this house based on this approval the bank has given to you. I hope I'm making sense on this. So you may want to know what is the advantage of doing a mortgage pre-approval. As I've said earlier, it makes you to know how much mortgage you can afford. You need to really have that information. Like you really need to know that this is the amount of house I should be looking at. So if you are living in a very expensive city and houses are very expensive, and what the bank is approving, you cannot even buy you a decent home, like something your kind of dream home, then you get to know that okay, I just have to keep saving, or I just need to increase my income, maybe get a second job or get another job that pays better, you know, or use the amount that the bank approve you and go look for a house maybe in smaller cities where you're staying. Like if you are staying in maybe in Manitoba, you can come to a smaller city like Winkler or Selkirk or Brandon instead of looking for a house in a place like Winnipeg. That's just an example. So if you know that you don't want to do a second job, you don't know how you're going to increase your income, you know, you have to look for alternative that okay, this amount that the bank is approving me for, I can only buy a house in a smaller city. So that's an advantage of the pre-approval. It just makes you to know where you stand and if you are really ready to start looking for a home to buy. Secondly, the pre-approval tends to give you an idea of how much the interest rate they'll be approving you for, because every mortgage has an interest rate depending on the term you want to carry the mortgage for. So if you go for a pre-approval, the amount they approve for you, it will be based on some certain interest rate. You get to know that okay, this is it. You get to get information from the advisor on terms and conditions of the mortgage, how the mortgage works, what you should be looking out for, other fees that you may be paying, how the mortgage works, like some costs that you may not even know. Because trust me, when you go for a full mortgage application, there are a lot of costs that you have no idea exists. Lawyer costs, closing costs, appraisal costs. Some homes the financial institution will need to do like an appraisal on the home, especially if it's like a private sale, to know if the value of what you're buying is worth it. Like if the realtor is telling you that this house is worth 500,000, the financial institution wants to know that okay, really this house is worth 500,000, because they're coming to stand for you for like maybe 95% of the remaining value of the house if you are bringing 5%. So they need to know that okay, the value of this house is actually this amount. It may be lower, they may just want to inflate it. So they want to know that what they are standing for is actually accurate, you know. So if you go for a pre-approval, it helps you to learn more about mortgage, the process. It helps you to know a lot of things. So that is basically the advantage of going for a mortgage pre-approval. But as I said, it is optional. You either go or you don't go for it, and it is free. So now we're going to be talking about the document you should go with for a mortgage pre-approval. So first of all, some institutions may not require you to bring hard copy like papers to show your income or whatever. They just want you to verbally let them know. Are you back?
I didn't know you were doing a video.
Okay, I'll soon be done.
Sorry.
So they want to know, they just want to know your income. Like you could tell them verbally. If you lie about it, they use the income you tell them to run an application. When it's time for you to come for the real application, you need to come with that document that you say. If you say you're earning 100,000 monthly, by the time you're ready for that application, you have to bring document to show that you actually earn 100,000, and it's that 100,000 that they're going to use to run the application and give you an amount of mortgage that you should be looking out for. So you're going to do yourself a disservice if you don't disclose the real income. So they'll need you to just come with the income, with information about your other credits in other financial institutions. Truly disclose it, like disclose everything you owe out there. So you should be like truthful about it, like disclosing things you owe, because there's some institutions do mock pre-approval, like they don't hit your credit. They use what you tell them to kind of run the application. Mock, they don't like check your credit. So if you don't disclose really what you owe, you are doing yourself a disservice, because if they do it, if they run the application, they tell you, okay, you qualify for a house of 700,000. By the time they're now running the application and they see that you didn't tell them that you owe $5,000 credit card from Canadian Tire, from Walmart, from a line of credit of like 50,000 and all that, if you don't disclose all those, then by the time you're running the application, you're not going to be approved for that amount. So those are what you should go with: information about your income, information about your debts everywhere, information about, you should also know the type of house you want to buy. Do you want to buy a townhouse? Do you want to buy a semi-detached? Do you want to buy where's the location where you want to buy a house? It may change at the end of the day after you go into the market to look for a house, but you need all those information to run a pre-approval for you. You also need to tell the financial institution how much you're going to be releasing as down payment. Are you going to be paying 5% down payment? Are you going to be paying 20%? How much are you going to be putting down as a down payment? That is very important also for a pre-approval. Of course, before going for a pre-approval, you already know how much you've saved. You know how much you can bring as a down payment. You also have to go with information about your assets and liabilities, like what do you own? What are the things you own? Even if it's not with that financial institution, spread out in other financial institutions. What do you own? How many cars do you have? Do you have other properties? What investments do you have? How much are they worth? Like, it's that we need to know what you own, and your liabilities, like what you owe. If you have, as I said, debt somewhere else, to want to weigh your asset versus your liabilities. It helps in the pre-approval process also. So you need to go with those information, because when you're running the actual application, they need to see documents to show you have all those things. So lastly, we're going to talk about what does a pre-approval actually look at. What are they looking out for? So a pre-approval actually looks out for 5 C's, the 5 basic C's that applies to most individuals. So for the first C is going to be talking about your character. Your character financially, like how good is this person with his finances. Basically, like what you have as credit, your loans. Does he pay up his loans at the right time? Does he miss payments? Does he max out all his credit card? You have a credit card of 5,000 and you spend up to 4,900. Like, they want to know your character with credit. The second C is want to look at your capacity. Like, what do you own? Like, are you capable enough to be able to handle this mortgage? Are you capable enough to be able to pay your monthly mortgage? Because you don't want a situation whereby you're missing your mortgage payment. You want to know if your income as at that time is strong enough to be able to hold the mortgage they're approving you for. Because trust me, I don't know for other financial institutions, but most financial institutions, if you miss up your monthly mortgage 3 times consecutively, then the next discussion you're going to be having is foreclosure of your mortgage. You don't want to lose your mortgage, so they want to know your capacity. Apart from your income, what other things do you have? Do you have investments there? Do you have RRSPs, TFSAs, something to, like, a backup, like when things go south, you lose your job, can you sustain your mortgage for some time? Those capacities are what the pre-approval is also looking at. They also want to look at your credit. Like, what is your credit rating so far? Everybody has a credit rating. I think the highest is like 900. You don't want to have a credit of like maybe 700 and below, and all those things are being updated monthly based on how your income is, how your credit is, sorry. So that is why in my previous videos, and I always tell people, like, always, if you have a credit card, make sure you don't spend more than 60% of it. Meaning, if you have a credit card of 1,000, make sure you always have a balance of $44,400 in your credit card. Don't max it out. All those things come together to tell what your credit rating is. If you have a credit card, you cannot pay the full balance. Are you paying the monthly balance? As at when are you paying the minimum payments? The minimum payment may just be $50 monthly. Do you also miss on that? You know, all those things come together to tell your credit. And in this society, whatever you're doing financially has to do with your credits. If you have a very good credit, you can get away with a lot of things. You can have access to a lot of things. But if your credit is bad, trust me, you're going to lose out. As little as even coming to look for a credit card of like just $500, you won't be approved because your credit rating is bad. It has sent a signal to all financial institutions that this person is going to be a bad debt. This person is going to be like a liability on you. It's not good with his credit. So the pre-approval gets to check on your credit too. Also, it's going to get to look at your capital. The fourth C is your capital, like meaning your asset versus your liability, which I've talked about earlier. What do you own? And what you own, is it more than what you are liable to? Is it more than your liabilities? Like, because a lot of people especially immigrants, sorry to say, owe more than what they own. They owe so much on credits, on lines of credit, on loans, and they don't have any investment. They don't have any savings culture. The only thing they have is debt, how to accumulate more debt, and the income is stagnant. You don't have any savings culture. Even they were not saying you should have millions of dollars in your investment. No, for the fact that you have a monthly commitment that goes into a TFSA or a savings account shows that this person has a good savings culture. We want to see that you have a backup. We want to see that if things go south, what does this person fall back to? Is it only dependent on his income? You know, we want to see that this person that we're going to advance, because mortgage is going to be like the biggest debt you're going to owe in this country. It's going to be like the biggest debt you're going to owe. So we want to know that you are capable, that you have the capital to be able to stand it, you know. So mortgage pre-approval checks for your capital. And lastly, it looks at your collateral. That's the last C. Like the mortgage you're coming for, as I said earlier, is it worth that amount? You come to say this house you're going to buy is for 600,000. Is it worth 600,000? Mortgage worth that amount of money? As I said, financial institutions will do an appraisal on the mortgage when you come for the full application. Like when you're ready for the application, they go to do an appraisal of the home to check the location, where is it located, is the amount what's that value. Like it's for 600,000. Is it actually worth 600,000? They want to know that your collateral is in good standing. There's no lien on it, there's no lien on it, there is no issues on that house. Because trust me, there are a lot of cases where a house is up for sale, but that house has a lot of things on that house. Like they want to check the title, like who owned it last, how good, is it tied down to some another name, like all those things. I want to check that this mortgage is actually in good standing. So that is the 5 C's of a mortgage pre-approval, of mostly what they look out for. This is what they look out for when you go for the application. So mortgage is really of a big deal, and if you really want to start, then you should be ready for it. You should be ready financially, psychologically, to begin with it. So this is the second series on mortgage. As I said, the first one was on down payments. This one is now on pre-approval. So I'll be talking about something else in the next video, so please watch out for it. Thank you. Bye.